Good morning. Good morning. Welcome. Welcome. We're just going to give everybody a chance to come on in and then we will get started. Good morning. Good morning. Good morning. Good morning. We're just going to give everybody a chance to come on in and then we will get started.
Good morning.
Good morning. Good morning.
I unmuted because I got the message you'd like to talk.
I do. I think we need to talk.
Okay.
But we're gonna give everybody a few minutes and we're gonna get started very shortly.
All right. Thank you.
Hi, this is Sonia Felton. I have a question. I know that the recordings that you do record every week, how do we get access to those recordings, or do we need to request them?
You just reach out to me, to myself or Mark, and we can send that recording to you.
Thank you.
Yes, ma'am. All righty. Good morning. Good morning. We're going to give it about 2 more minutes. We're going to get started at 9:05.
Okay, good morning.
9:05. All right. Good morning. Good morning, everyone. Welcome, welcome, welcome to the Urban League of Greater Atlanta Entrepreneurship Center Power Hour. We are here to make sure that you get this great, amazing knowledge to help you take your business to the next level. And today we have a great one, great one, great one. Now, a lot of you may have came to our um, Meet the Money people last week, got some phenomenal information. So we're going to stick with that same type of topic, and we're going to bring in the amazing Christopher Faircloth to talk to us a little bit more about what are the lenders expecting? What type of information should I have prepared? Just so we can understand exactly what do I need to do to be ready for funding. So I'm not going to say another word. Chris, I'm going to turn it over to you, and the floor is yours.
Thanks, John. I appreciate the introduction, and thanks everyone for having me here today. My name is Chris Faircloth with Early EQ. Work as a business loan broker during the day, and then also assist the Urban League with their small business clients in preparing for lending and funding and all that good stuff. So I was just telling John, I'm kind of recovering from the plague, so if I sound a little off or you hear some errant coughing, I'm still on the mend. So please disregard that. So let's see here. Hang on one second here. So a little bit about me. This is my smiling face. As I mentioned, I'm a business loan broker with Newly EQ. During the day, I work on a variety of different funding types, including equipment financing, SBA lending, commercial mortgages, working capital requests, and that type of thing. And I have over 15 years of experience in business financing, and I've worked at Huntington Bank, which has now arrived in Atlanta, and Chase, and as well as worked in a CDFI or community development financial institution doing mission-oriented lending for underserved entrepreneurs. So I have a kind of a broad background there. So just in case you weren't aware, I'm available as a subject matter expert for Urban League clients and program participants. There's zero cost consulting for me if you have any questions or concerns regarding business funding or financing. For example, if you're getting started or just kind of in the early stages of trying to figure out what you need to get together or how to prepare. So you're welcome to reach out anytime to see about scheduling a no cost one-on-one session with me. So the agenda today, we've got our brief overview, how traditional lenders evaluate your request. We're going to cover some pieces of personal credit and then some common documentation tips and red flags. So as you can imagine, preparing for lending is a very broad topic. So we're going to try to narrow it down a bit and focus on the playbook that lenders use when they're looking at traditional lending requests. And so first question that I have for you guys today is anyone currently looking for business funding, or does anyone have that on deck coming up in the not too distant future?
Yes, I do.
Okay, great. We'll use you as an example. What are you looking to accomplish?
I'm looking to add staff, both part-time and contractors. I'm also looking to have a local office, or maybe a place where I could meet clients when need be, but definitely trying to build my virtual business. I'm already a national person that provide services to individuals who receive Social Security and disability. I've been doing it alone since 2023, but I'm now ready to add people to support me in that endeavor, and want to make sure it's virtual because working in the office is not always, the best for someone. So want to, upscale my work from home environment.
Gotcha. Okay. So you've got expansion plans, perhaps looking to add to payroll and expand. Does that sound about right?
Yes, and I'm already looking at Gusto for the payroll in terms of a payroll system, but just looking for more funding. Like I'm trying to go after a state contract, which
Okay.
require you to have $50,000 line of credit. I crossed that hurdle, but I just know 50,000 is not going to be enough for what I'm trying to do. So just want to understand more about, more opportunities.
Gotcha. Excellent. Okay. Well, I appreciate you sharing. Thank you so much. Okay. And as we go along, if you guys have any questions, feel free to jump in and throw them out there, but we'll kind of keep this moving at a quick clip so we can keep it at an hour. So business loan overview. What does a small business owner need to do to get a bank or other lender to say yes to a loan request? And so we're going to cover a lot of items coming up here, but first and foremost, start with a clear, clear direct request or a clear defined request. So for example, exact loan amount, exact use of funds, and a clear business narrative. So just in the example we have right there, we didn't exactly discuss loan amount, but you've got a clear use of funds, and you've got a clear business narrative as to what you're going to use the funds for and how it's going to advance your business going forward. So great start as an example. So first thing you can do beyond that, introduce your business to a lender. And so one of the hardest things I think for people is to find a lender that's going to be appropriate for their type of lending. The default for a lot of people, I believe, is they say, hey, I bank at Truist Bank. I'm going to walk into the branch and they're going to help me with my loan requests. And they may or may not, depending on the situation. But lenders and banks in general have different tastes on business lending, different tastes for working with certain industries, different tastes for working with startups or not a startup. And so just because you happen to bank with a particular bank or a particular lender doesn't necessarily mean that's the one that's going to be the best fit for your request. And so it's important to do your research, reach out. You can talk to people like myself that may be familiar with what lenders are more amenable to your type of lending requests and those types of things. So, but a great way to start is, if you do happen to have a bank that you work with, you can determine the correct contact at the bank for small business lending. So the branch is not always the best starting point. Sometimes the branch managers will do that. Other times they won't, but you can always start there and say, hey, I'm looking for a small business loan. Who should I talk to? Are you the best person, or is there someone else that I should be speaking with? Then from there, you can determine the bank or lender's minimum criteria, and we're going to talk about some of that coming up here. And then often this can be located on the website, but sometimes not. Sometimes you'll need to reach out directly and get more information from someone. And then you can ask about the loans the bank or lender may provide. So you may say, hey, do you do lines of credit? Some will, some won't. Hey, do you do startup lending? Some will, some won't. And so you can help to narrow it down. And that way, if you do your footwork up front, you've narrowed down the lender that's going to be more, or help to narrow down the lender that's going to be more likely to work on your request, as opposed to throwing in an application to a bank that may, bank or lender that may really not ultimately be the one that's going to be the best fit for your request. All right. So we'll kind of focus on banks and traditional lending, but there are some other options out there which you are probably aware of, but just a few examples. So you've got credit unions. Those tend to be great on rates and maybe a little bit more flexible than traditional banks. Of course, you need to be a member and fit the member criteria. There's others that are maybe not quite as well known, microlenders or community-based lending programs, which I worked for one of those for 8 years in Ohio. A great example of that is ACE in Atlanta. I think they're the largest one in the area, but there are multiple that work in Georgia. Some are locally based, some are regional or national, but they tend to be more community-focused, more mission-oriented, and may be more flexible, particularly on small business lending or where you may have some sticking points that traditional banks are not as fond of. You've also got online lending platforms, which run the gamut. Some of those are good, some of them not so good, but those are some options out there. Then you've got other more specific types of financing options, like equipment or inventory financing companies that focus specifically on those types of lending. Also commercial mortgage if you're looking to buy a building. Sometimes those are better or maybe at least a little bit more quick, because they do have that particular focus. And then you've got others like merchant cash advances or embedded finance that tend to be more focused on getting things done quickly, but there is a definite cost trade-off there, and those you need to be wary of, but they are out there, typically more in emergency situations than your preferred choice, but it is a thing. So what matters most to lenders? This will vary a little bit, but no matter who you ask to lend you money, lender, generally speaking, will be looking for a business owner who knows the business, has the ability to run it well, and is willing to work hard to make it succeed. And so they're looking for people that have a background in what they're doing. If you're already running it, obviously you've got that background. If it's a startup, they tend to look for people that have experience in the field. So if you say, hey, I want to start a restaurant, I was a general manager of a restaurant for 5 years, now I want to start my own, you can make that direct beeline to the connection from experience, because having prior experience is often a dictator of how quickly you'll be able to ramp up going forward, starting your own business in that situation. A business that is financially sound, or if it's brand new, appears to have the ability to make enough money to pay its bills, give its owner an income, and pay back the loan. In the case of new businesses, sometimes they'll look at your outside income as a backstop, say, hey, I've got some income from a job. I can start my business while I still have that job, and that gives me some support. As far as businesses being financially sound, for traditional lending, that's true. You have some of the more flexible, we'll say, lenders out there that really just want you to be able to be sound enough to pay back their money. And those are typically more of emergency situations. So there is some variability there. And then collateral to cover at least part of their lending risk in business or outside. So collateral, if you're not aware, is something that can be pledged as an asset that could be sold if you're not able to pay the loan back in, worst case scenario. And so in a consumer situation, if you've got a home mortgage, your collateral for that mortgage is your house. If you've got a car loan, your collateral for that car loan is the car. And so that's an example there. Also, an investment from the business owner or equity injection. So it's usually the business owner's own money that gets put into the business to pay for some of the things that it needs. So there are times where lenders will 100% finance your request, but a lot of times in traditional lending, they want to see that you have some of your own money in it, so you have skin in the game, so to speak. So next topic here, how traditional lenders evaluate your requests. So this is the general playbook that traditional lenders use to evaluate your requests. There is some variability depending on loan programs and lenders. However, if you follow along with this and you're able to answer the questions and adequately identify any problems, generally speaking, you'll have a much easier time because you're following along with the same playbook that a traditional lender would be following on, or looking at the same items that they would be looking at. So what that is called the 5 C's of credit. And so those are character, condition, capital or contribution, capacity or cash flow, and collateral and guarantees. So we're going to cover each of those topics here in the next few slides. But again, these are the very, very common baseline of traditional lending, the 5 C's of credit. So first, character. Your personal reputation and general impression you make on your lender, your integrity. So there are a number of things that a lender does or could consider within this bucket, but some examples are whether you have lived in your neighborhood for a long time or whether you have just moved in. So I can use a client example that I have that I recently got closed a couple of months ago. We got a line of credit for a home healthcare company, and we ended up initially getting a larger amount, but because the client had only lived in his neighborhood or in his at his address for a shorter period of time, they actually lowered the amount a little bit just because they considered that to be an additional risk factor. Seems a little weird, but that is something that sometimes they'll take into consideration. Whether you have an account with a bank that you're requesting a loan from, and whether you've ever had a loan from a bank or another lender. So do they have, if you're working with a bank, do they have experience working with you? And do you have a track record of paying off other loans that you've had with other lenders? Management experience in the industry, like I mentioned before, past credit history, which I think is no surprise to anyone, banking relationship and repayment history, which kind of ties into above, and legal history. So that can be a variety of things from civil, like, have you gotten sued by anyone before? Do you have tax liens? And it can refer to criminal as well, which sometimes can be a factor in loan approval. Going on with character, personal credit scores. Let's see here. So I'm going to move my little thing around here. Personal credit scores are an indication on the ability or willingness to repay. And I think at this stage of the game, everyone is familiar with that. Therefore, it impacts the character in the 5 C's of credit. So how you pay your bills, which is information that's reported by credit bureaus in most cases. And bad credit can impact the possibility for approval and will likely impact cost. And so we're going to cover personal credit here after the 5 C's, but we'll have that coming up here shortly. Let's see. Okay. So capacity or cash flow. So whether your business makes enough money to pay all its bills, including the new loan. So the amount of money that you make or expect to make, cash flow, should be sufficient to pay all of your expenses and allow a little extra in case something unexpected comes up. So in most cases, this is going to be probably the #1 item for most traditional lenders. So while it's great that you have collateral, while it's great you have the other things, what they really want to know is, are you going to be able to pay this loan back? So a lot of people will say, like when I've had declines in the past working with clients, they'll say, hey, but I've got collateral that covers the whole amount of the loan. So they could sell my house, it'll cover the entire loan. There's nothing to worry about, even though my business isn't making as much money as they want right now, or maybe my credit's not so hot. And so the thing to keep in mind with most lenders, there are some exceptions, is that they're in the business of making loans. They're in the business of getting paid back for making loans. They're not in the business of selling houses or selling cars or doing any of the other stuff. Those are just backups. Their primary thing is they want to make sure that you have the ability to pay back the loan. And so that's when they're looking at capacity or cash flow. So if you're an existing business, the lender will look at how much money you have made in the past, which is your historic cash flow, as shown in your business financial statements and tax returns, which is usually the last 2 to 3 years plus current year to date. There are some more expedited loan processes where they may skip over some of that depending on the lender and program, but in a traditional process, that's a good rule of thumb. If you're just starting your business, a lender will rely on your business plan, your outside income, as I mentioned before, for example, from a job, your estimates or projections of how much money you'll make, which would be your revenues, and how much money you'll need to spend, which is your expenses. So sometimes you can get startup lending that will lean on projections. Some will lean more on your current income that you have, but ultimately it's frequently a mix of those two items. All right. Any questions so far? Nope. Okay.
Nope.
I'll continue. Okay. I'll continue on. Thank you. Collateral or guarantees. So most lenders also require business owners to personally guarantee the loan, which equals a promise to repay the loan even if the business fails. And so this is a common question that I get. How can I find a loan where I don't have to personally guarantee it? And so unless you're a larger business, not a personally held business or closely held business, or something like that, for most small business lending, it's going to be a requirement. And SBA being one of the most common small business lending programs, they require anyone that has 20% or more ownership to personally guarantee the loan. It's a non-negotiable. So, but as it says, what that means is that because you as a small business owner are so intertwined with the business that if the business fails, they want to know that you're still going to be able to pay it back. So they are going to require that you guarantee it. And so even though, whether or not the business is successful, we hope that it is, but even if it's not, you're still going to be on the hook personally for paying back that loan. And so definitely something that's very common, but also something you want to be careful about, because you can't just say, oh, business didn't work out, I'm going to walk away, don't have to pay this back. So most of the time, unfortunately, it doesn't work that way. Capital or contribution. This includes money that you have invested in the business. It shows your commitment to the business and what you have at risk if the business fails. A lender expects you to have contributed something to the business. Equity injection is another term for it. In other words, have some skin in the game. So equity injection varies based on the lender or financing source. Be prepared to provide at least 10 to 30%. Especially with traditional lenders, lack of equity usually means the loan will be turned down. So that is the case. There are some situations. So, for example, the SBA does allow in some situations to, for example, allow a lender to 100% finance a real estate purchase. So there are times where that can be set aside. But frequently, if you're making any sort of physical purchase, where there's equipment, real estate, things of that nature, or it's a startup lending situation, minimum is generally 10%. That's the SBA minimum. If you're not looking at SBA, it's often 20 or up to 30%. So definitely something to keep in mind as you're going forward and looking at new lending opportunities. Okay. So condition. Condition are the loan conditions that a lender considers when approving your loan. And so a lot of times the condition is actually things that are not necessarily related to you, right? It's the condition and the overall outside world that you're involved in, right? So a great example that does impact you directly: purpose in terms of the loan. Does the funding clearly improve revenue or strengthen the business, or is it covering losses, right? So they want to be pushing people in the right direction. And so are you able, when they look at the terms, are you able to afford those terms? But there are some other things that are outside of that. So the economic environment, or broader factors like interest rates, inflation, or recession risk, supportive or tightening. So you may look at the environment right now and say, hey, with tariffs, it's kind of up in the air. We're not quite so sure what's going on. It's hard to make future thinking decisions. And so we can look right now, and quite honestly, lending has gotten a little bit tighter in the current environment. And so that's a great example of looking at condition and saying, hey, conditions are not quite where we want them to be, so we're going to get a little bit more restrictive on our lending requirements. Market and timing factors. Is this the right time and location for expansion, given demand, competition, and revenue trends? So how are things going for you? How are things going in the market that you're in? So we may look at Metro Atlanta and say, when we look at the performance of coffee shops in Metro Atlanta, have our portfolio of coffee shops been performing well? And does it make sense for us to lend to more of them, or does it seem like it's a saturated market for coffee shops right now? And so that's something that you can't control, but something you can research in advance. Industry risk. Is the business operating in a stable, growing industry or a volatile, high failure one? So this comes up a lot with a lot of the clients that I get referred to me. Frequently, they'll go to a lender that may be a little bit more restrictive, and they'll be in an industry that maybe is a little bit higher risk and has a higher overall default rate. And so I get referrals a lot of times for landscapers, long haul trucking, restaurants, things of that nature that just traditionally are either higher overhead and lower margin, or very exposed to economic cycles where there's a lot of boom and bust there. When things are good, they're great. When they're not so good, they're really bad. And so those are some things that you can't change. That's just the industry that you're in, but it is something that a lender takes into consideration. Okay, so that's the 5 C's and the general playbook that lenders will be looking at. Any questions before we roll into personal credit?
No.
Okay. All right. So personal credit, just want to touch on this because it is something that obviously impacts things a lot. And it's a common question when people are looking at small business lending. So first and foremost, personal versus business credit. Both important things. However, small business borrowers sometimes over-focus on the importance of business credit. So I never say it's bad to develop your business credit, but often I will get questions to say, hey, how can I find a loan that only focuses on business credit, doesn't look at personal credit? And typically it's someone that maybe doesn't have ideal personal credit. They're trying to sidestep that. And oftentimes you're not able to do that. I wouldn't say it's impossible, but that's infrequent, particularly in small business lending. And so personal credit is typically, particularly in traditional lending, either the only factor or a very large factor between business and personal credit. So in most instances, developing business credit will not cause lenders to ignore personal credit. And I can say from my own experience working in small business lending for 15 years at this point, I don't think I've ever had a time where business credit has overcome issues with personal credit. And so in cases where personal credit is a concern, effort made to repair personal credit almost always trumps effort towards business credit. So if you've got to focus your time on doing something, working on improving or repairing personal credit is almost always going to pay more dividends than trying to ignore those issues and focus on business credit instead. Now, if you've already got great personal credit, you want to work on your business credit, absolutely go for it. Can't hurt you, but it's not going to. Business credit isn't going to resolve personal credit issues. So I always like to cover that because that's a common misunderstanding, I think. So your personal credit standing, how do you find out how you'll look to a lender? So I don't think this is any surprise. Order a copy of your credit history and FICO score. Largest credit reporting agencies are Equifax, TransUnion, and Experian, and all are required to provide a free credit report, which you can go to annualcreditreport.com to do that and get a free one, currently weekly from all 3 of the bureaus. The one thing that doesn't do is it doesn't give you a free credit score. You do actually have to pay for the score if you go through that, but you can get the report and see what's on there for free. So next here is talking about the FICO credit score. And so FICO, which is a Fair Isaac Corporation, is a credit score calculated from both good and bad information in your credit report, such as how much money you owe compared to how much money you make, how much money you owe on personal and business loans, other credit factors such as if you pay your bills on time, if you have ever had judgments or filed bankruptcies, any other thing, collections, those types of things. And so the breakdown here generally is amounts owed is 30% of the impact on the score. Payment history is 35%. 10% of types of credit that you have in use. So a positive there is actually having a variety of different lending. So maybe you have a couple of credit cards, and maybe you have a car loan, and maybe you have a mortgage. And so it doesn't really make sense in a lot of situations to say, hey, I want to improve my credit score, so I'm going to go buy a house and get a mortgage. But it is a factor. Having a variety of lending types is a factor in how your credit is scored. 15% is length of credit history. So it's important to start early and try to keep it positive, and also keep open accounts that you've had for a long time. So sometimes it can be a negative to close out long-standing accounts on your credit score. And then new credit is 10%. So you want to be judicious about your applications. It can be a negative if you go and just apply for all sorts of different lending all over the place all the time. It can be tempting sometimes when there's a promotion in the store and you say, hey, I'll get 30% off because I got this new credit card. But if you have long-term credit concerns, or you're looking at applying for a business loan or other types of loan in the future, maybe better to not do those types of things and just try to stay on the straight and narrow. Lenders may use different FICO scoring models, which can result in varying scores from the same credit bureau. So you've probably either heard or had your own situation where you've applied for a loan. They've said, hey, your score is this. Then you've applied at another bank or another lender. They're using the same bureau and they get a different score. And you say, how does that make any sense? So kind of an analogy there is that the credit bureaus, they just have the information, right? So you say, hey, what's my TransUnion score? There's really not a TransUnion score. It is just like, it's just kind of like the list of ingredients for if you wanted to make a cake, right? But the credit score itself is actually more like the recipe. And so lenders can request tweaks to the recipe to get a slightly different result. And so depending on what tweak to the recipe your particular lender is using, they may come up with a slightly different cake than what another lender may come up with. I don't know if that's a great analogy. I was trying to think of how to put it together, but that's kind of how it is. So there are some scoring models that are used more often by mortgage companies, some that are used more often by car lenders, and so you can be using the same base ingredients from TransUnion or Experian or whatever, but get a different score based on the tweaks to those scoring models. And another one that comes up a lot is Credit Karma. They don't use FICO at all. They use a thing called VantageScore, which is a completely different scoring model that nobody really uses. And so that's why when you go to Credit Karma and you get the score that they give you, it almost never matches what you would get back from a lender. And that's because they're using a completely different scoring model. And so kind of confusing, but that's how it works. So what is a FICO score? Higher score means less potential risk for lenders. I think that goes without saying. And then lenders use FICO scores as one factor when deciding whether to approve a loan, what terms and conditions to require on a loan, and interest rate or the cost of the loan to you. And I think for most people that's no surprise there. For smaller loans, generally those below $350,000, credit can be a more outsized factor in approval than with larger loans. So there are some more credit-based approval processes for smaller loans. And so it's always good to try to keep up on your score because of that. What to do if your credit score is low? Some things that can be fixed. If any mistakes are found, contact the creditor in writing to ask to have the report fixed. Contact the credit bureau in writing to find out how to correct wrong information. All 3 credit bureaus accept disputes submitted online, and provide copies of your letters to your lender. If the report is correct but negative, try to fix it before applying for a loan. So obviously you make credit payments on time, so that's an easy one. Reduce the amount of debt you owe. So sometimes if you have a lot of revolving debt, which is a lot of debt that's on credit cards, as a percentage, if you can pay that down, that will help improve your score. You can also try to take care of accounts that are late. So if you can bring things current, that should have a fairly quick improvement. It's not going to resolve all of the historical issues, but will be a help there. You can also try to work with some of your creditors to see what you can do to try to get in their good graces just by reaching out to them. You can work with a nonprofit that will provide free credit counseling, and there's some of those out there that could try to help you work through that process. And there's some other programs, and using Experian Boost as an example. This is specific to Experian, but for additional credit report. I'm sorry?
Nick!
Okay.
Everyone, please make sure you keep your phone muted unless you're speaking or have a question. Sorry about that,
Um,
Chris.
so- no worries. So there's some things. So Experian is one that I've run across that I think is pretty cool. And I believe there's some other programs and things like that, like this
Yes,
out there.
I do have a question. This Miss
Sure, shoot.
Jackson.
Sure.
This is Tasha Jackson. I was calling on the behalf. Is this a certain type of bank do we have to do our loan with, or it could be any bank?
Oh, you mean as far as me being a lender? Is that what you're talking about?
Yes, yes, like me and the lender get my, because I think I'm about ready.
Okay. Well, so that's a great question. So this is just general information. You're welcome to work with any particular lender that you want to, and in the capacity that I'm working with the Urban League, I'm just here as essentially a consultant for your clients like yourself. So I can help you get everything together and help you prepare for that process and help you find a lender that's going to be a fit. So while I do lending during the day, that's not a requirement. That's a whole separate thing. I can work with you and work with a different lender, and that's fine. So if that answers your question.
But yes, okay, yeah, that's why I was just asking.
Sure. Yeah. And this information is generally applicable across the board for most traditional lending.
Okay.
So, yeah. But great question. Thank you for asking. So going back to Experian Boost. So it's kind of a neat program where what they'll do is they let you take your utility bills and other bills that don't report to credit, and they'll allow you to report to Experian as a credit bureau to help you improve your credit score. So in some situations, people, maybe their credit is not so great, but maybe they only have one or two accounts that are reporting. And so you have one or two accounts that are reporting, and one of them has some lates, that makes your score look abnormally bad. But a lot of people pay things on time that just are never shown, things like rent or utilities or other things that just don't show up on the credit bureaus. And so there's been more of a push to be able to reflect those types of items, especially for people that may not have as many accounts reporting as others. And so Experian Boost is one of those programs. I haven't used it myself, but it's something to look into if you maybe your credit isn't exactly where you want it to be. You think you'll be applying for a loan in the future, and you have some other bills that maybe traditionally don't report to credit, but you're paying them on time. And so you can look for programs like that and see that's another way to try to improve your score without having to do anything really different. All right. Any questions about any of that? Nope. Okay.
No.
We'll keep moving forward. All right. So common documents, tips, and red flags. So just kind of a list of items. We'll run through some of these just so you're aware. Probably not a shocker, but just so you kind of have an idea as you guys get ready and prepare yourself for business funding. So common documents needed in traditional loan requests. So these are fairly standard. However, depending on the type of program and dollar amount that you're requesting, sometimes you won't need all of these. There are some lenders, particularly if you step outside of SBA and those types of things, where they have more expedited underwriting processes where they'll lean more on bank statements and that type of thing. But for traditional lending, these are common items that you'd want to have available. Or if you don't have available, work on getting them together so you're ready when you go to apply for a loan. So some common documents would be financial statements like profit and loss or balance sheet for your current year, and sometimes historically. So if you have an accountant or bookkeeper, sometimes they can run those for you. If you're doing it yourself with, for example, QuickBooks or a program like that, you typically can just run it from there. If you're not tracking your financials and you're looking to apply for a loan, that'd be something I would start doing, and perhaps reach out to the Urban League for some direction there. I know we have some great other subject matter experts that are adept in that field, but that may be something that you want to work on. So next would be business tax returns, last 2 to 3 years, full returns with all schedules, and then personal tax returns for all 20% or more owners, also the last 2 to 3 years. And so I run into this from time to time where people say, hey, I'm ready to apply for a loan. I say, great, send me your last couple of years tax returns. And they say, well, I'm kind of behind on filing my taxes. And so we say, well, unfortunately, in many cases, we're not going to be able to move forward until you have that handled. And so if you have them but can't find them, great time to go and hunt them down or get them from your accountant or go download them from H&R Block or whatever. If you have not been keeping up on your tax returns and you think that you're going to be looking for lending, to give you the best options and best chances, you'd want to go and do your best to take care of that. And given that we're in tax time, it's a great time to address that.
I have a
Um,
question regarding that.
Sure.
Uh, I'm permanently disabled 20 plus years and I don't have to file taxes. Would that be a problem?
That's a great question to ask. Thank you so much. So in the cases where you haven't filed tax returns, not because you just didn't do it, but because you're not required to, they're not going to hold that against you, right? So you can't produce something that doesn't exist because it's not supposed to exist, right? So that's not a fault on your side. So when you go to apply, you'd say, hey, I've been on disability for the past 20 years. I'm not required to file. And so generally speaking, that would be enough of an answer for most lenders, I think. So that's an excellent question to ask, and thanks for asking it.
Thank you.
Next one is a personal financial statement for all owners 20% or more. So this is a form that you fill out. A lot of times banks will have you, or lenders will have you do this as part of the process. It's not something that you necessarily have to have done ahead of time, but it is a very common item. And basically what it does is just list your personal finances. So it lists all the assets that you own, all the liabilities that you have, shows where you live, talks about your income. So it's just a general summary there, but that's a very frequent item that would be requested. Business bank statements last 3 to 6 months. So this is a common one. And so sometimes you'll find lenders that'll go just off of bank statements. Frequently, they cost a bit more because they're being a little bit more flexible. They're not asking for as much documentation, but you can find some like non-bank lines of credit and things like that where they'll just look at your business bank statements. However, it's becoming more common now to request that as part of the package. And the SBA, as an example, just made a recent change where they're actually requiring lenders now to start verifying the debt payments that clients have by looking at their business bank statements. And so that's something that was a thing, and I think will, because of the change for the SBA, will become even more common than it was. So something to keep in mind there. And when you do have your business bank statements, some of the things they look at is what's taken place on there. So not only what money is coming in and out, but have you had insufficient funds coming through? Have you been having payments returned? Things like that. And so those tend to show in a negative light. And so if you're having those issues, and obviously people don't want to, but if you're able to address those, you want to try to clean those up and try to avoid having those on your bank statements before you go and apply for a loan, especially within the last 3 to 6 months. Articles of incorporation or organization. This is just you registering your entity with the state. So if you have an LLC or an S Corp or whatever, the document that shows that you registered that. Operating agreement or bylaws. These sometimes you'll need, sometimes you don't. Typically, if it's a one-person ownership, they won't request this. If there's 2 or more, definitely will request it. And what it is basically just the kind of agreed rules between the owners of who does what, who's responsible for handling lending decisions and things like that. And so if you don't have those and you have more than one owner, it may be something to look into. There's templates online. And of course, it's ideal if you can get an attorney or something to do it for you. Not everyone can afford that, but something that may be requested as a heads up. EIN confirmation letter, sometimes they'll ask for this, which is just the EIN letter that you got from the IRS when you registered your tax ID for your business. Sometimes you can get around that. They'll just look at your filed tax returns and use that as justification, but sometimes they'll ask for the actual letter. Ownership breakdown, including percentage ownership. That kind of goes back to what we talked about before, where it's the ownership of whoever's in the business. If you're a single owner in the business, it's 100% you. That's an easy one. If you have multiple owners, that can be a little bit more difficult, but ultimately they're going to want to know who owns the business. And then finally, use of funds breakdown. So if you say, hey, I want a $50,000 loan, they're going to want to know how you're going to spend it generally. So you say, hey, I'm going to spend $20,000 on new equipment. I'm going to spend $20,000 on building out my office, and I'm going to spend $10,000 for marketing. So just a breakdown like that. Any questions there? All right.
Nope.
Keep moving forward. Okay. Some additional documents for specific situations. So this only apply to if you happen to be in these situations, but they would be common things. So if you're buying real estate or a business acquisition, a purchase agreement or a draft purchase agreement. If you're looking for equipment financing, an equipment quote or invoice is a common one. Accounts receivable or payment aging reports for lines of credit. That tends to be for larger lines. A lot of times you can get around that for small business lines of credit, but sometimes less for that. Inventory report, if the inventory secured financing, again, not as much of a concern in small business lending, but that is something where basically you just say, hey, here's the inventory. Can you lend me some money against this inventory that I have? Payment statements for existing loans if you're refinancing. So this is common, particularly with SBA financing. So if you want to refinance, say, a more expensive loan into an SBA loan, they require that loan to be paid on time for 12 months before you refinance it. And so they request both payoff statements to show how much you owe, and they'll also request a payment history to show that you've been paying it on time. So that's something to keep in mind. Business plan and financial projections for startups or expansions. Lease agreements, sometimes they'll ask for that if you have a leased location. One of the big things that comes up is, and I'll use SBA as an example, they want your lease to match, or at least have the option to renew to match the term of your loan. So if you're getting a 10-year loan, they want to make sure that you can stay in your space for that length of time, because it's no fun to have a loan and you get booted out of your space 5 years in and you still got 5 years to go and you can't operate. So that's the concern they have. Rent roll and tenant leases if you're doing investment real estate, and then contractor bids and construction budget if renovation or build out. So this one, it comes up a lot where people will say, hey, I want to get a loan for X dollar amount and I'm going to do build out. And I'll say, hey, well, have you gotten some quotes on that yet? And they're like, no, I just kind of ballparked it. And we say, well, you know, unless you're a professional contractor, people tend to be not so great at ballparking how much construction costs. So we would like you to get some bids or quotes before we'll move forward with the lending process. So just a few specific situational examples there. So tips for loan applications: have current, accurate financial statements. You know, again, going back to, are your taxes filed? Do you have financials that are current, or can you produce financials? It's hard to evaluate a loan request if we don't know what's been happening with the business. Make sure all your documents match information. I have this come up a lot. I have a client I'm working with right now where I got information in, and some of it was from October, some of it was from December. Some of the numbers were, you know, 10% over, some were 10% under. They didn't quite match. And so not only does it make it difficult to underwrite, it makes the lender be concerned that they can trust the information that you're providing. So whatever documentation you're providing, you want to make sure that everything matches between the different documents. Very important. Prepare a clear explanation of any revenue dips or anomalies. So, hey, tough situations happen, bad stuff happens, but you want to be prepared with an explanation, both of what happened, try to put it as positive light as you can, and also how you've resolved it or how you're going to resolve it. That's also important. So much better to be able to address any negatives ahead of time instead of submitting things and having the lender be like, well, wait a minute, what happened here? Reduce revolving personal debt before applying if possible. So if you have high credit card debt, if you can bring that down a bit, one, that helps your cash flow, whether personally or within the business. Also, it can help your personal credit score. I know that's not always possible, but if possible, something to think about. Avoid taking on other debt before or during the loan process. So I have had situations where I've been working on a loan, and in the middle of it, someone said, hey, I went and bought a car. Guess what? I'm so excited that I bought this car. And that additional car loan throws off the numbers, the cash flow, and no longer makes the loan viable. So it's best, if you're working on getting a business loan, to focus solely on that, not take on any debt leading up to or during the process. Ensure all taxes are filed and payment plans documented. We kind of talked about that before. Make sure everything's filed. If you are in a repayment plan with the IRS, in most situations, that's okay unless it's something really crazy. But you want to make sure you have documentation of that. And then, of course, that you are actually honoring those terms that you have with the IRS. Prepare a clean, organized document package. Kind of going back to what I said, it's really difficult for a lender to move your loan along efficiently if you don't have all the documents together. They're messy, they don't match, you know, they're written on the back of a napkin or whatever the case may be there. I had another client in the past, done loans for him, loved working with him, but without fail, every time I asked him I said, hey, here's a list of documents we need, he'd send me about 25% of that and fill in the rest, not with what I requested, but with all sorts of other stuff like, hey, I was in this newspaper article, here's some pictures of my office, here's some great stuff we're doing in the community. And I said, you know, these other things are all great, definitely will include it, but we really just need documents that we've requested. And so following those instructions is key. Preparing a clean, repeating the same line. Be ready to explain how the loan will improve cash flow or otherwise benefit your business. So basically have a clear narrative of why you're applying for the loan, how it's going to assist your business, and how it's going to move you forward. Some red flags to avoid. Some of these, they just kind of are what they are. We can't change reality, but if you can avoid these, good. Declining revenue without explanation. So generally speaking, a lender wants to see that you're on the upward trend. That doesn't always happen, right? We've had COVID in the past where a lot of people's revenue was down. And so that was an explanation that we could say, hey, this was temporary because of COVID. But basically, you don't want to just submit negative looking items without any sort of context there. Try to do your best to put a positive spin on it, explain what happened and why that's not going to occur again. Inconsistent financial statements or documents, like we just talked about. Excessive existing debt or thin cash flow. So if it looks like you're just throwing debt on debt on debt, that's not really helpful. You want to make it look like it's strategic, because that's what we hope it is. And then of course, cash flow, you want to make sure that you can cover those payments. It's not, doesn't look too hot if you've already got a bunch of debt, you're throwing more debt on and it looks like you can't afford it. Repeated overdrafts or negative average balances, which you talked about before. When they're reviewing bank statements, that's a negative because it looks like you're not able to manage your cash flow or your accounts. Unfiled tax returns, like we talked about, missing documents or poorly prepared documents. Financial crisis applications, obviously, if you're in a financial crisis, it is what it is. However, obviously, if it's clearly looking like you're trying to keep the Titanic from sinking, that negatively impacts your opportunity for getting lending. And so what people tend to do is wait until there's a crisis. And so the better thing to do is look, you say, hey, can we prepare for headwinds? Or if it looks like things are maybe not going the right direction, that may be the better time to apply for even a line of credit where you don't have to borrow immediately, but you have it available. Waiting until it's a crisis situation really negatively impacts your possibility of getting an approval. Or if you get an approval, it's for predatory types of loans, which are not really going to help you in the long run. Vague use of funds, just working capital. They tend to want a use for it that's more specific than that. Applying for more debt to cover existing losses. So again, trying to kind of keep the ship from sinking. I mean, you do what you got to do, but that tends to not be the best situation. You try to apply for things before you get to that point. And then leaving out important information or deliberately hiding details or providing misleading information. And so I've had clients that have tried to do that even recently. And I say, hey, one, in most cases, a lender is going to find it anyway, and you just waste a lot of people's time. So I have a client right now trying to refinance a fleet of trucks. And they did not mention to me that they had been late on some of their payments. And so when we got to the point of saying, hey, we're going to look at SBA for this, it turns out they're not SBA eligible. And so we have to go back to the drawing board there. And they kind of knew that was the case, but didn't disclose that. It ended up wasting a lot of our time. Then the other part of that is that if you're deliberately providing misleading information, that can put you in a situation of being exposed to committing loan fraud. And so a lot of people think that, hey, I'm just just adding a few things here, not including some things here. It's not really a big deal, but no, it can actually be a really big deal. And so I've had clients who are like, hey, Chris, can't we just kind of not mention that thing? And I'm like, one, no, that would be a bad idea. And two, I'm not going to be in the mix with you if something happens. I'm not going to do that. And so you want to avoid that. You never want to put yourself in legal jeopardy just to secure a loan. Wrap up and questions. So that is all I have for today. And it looks like we're about 6 minutes before time. I know that was a lot of kind of dry information, but I'm happy to answer any questions that anyone may have. And you're also welcome to follow up with me after at any point. So I'll open it up for questions.
Hi, Christopher. I am Celestina Samuels. Feel free to use Tina.
Okay. Hi, Tina.
Hi. And I plan to follow up with you for a one-on-one session.
Okay.
The presentation was very informative, and I could follow along. I do have a question, not regarding your presentation, but the first person who spoke talked about her business. She's in Social Security. I'd like to connect with that person if she's willing.
I didn't catch whose name that was, but if you're still on, if you'd like to jump in, feel free.
Oh, that was me, Monet Edgerson Padaway.
Okay, I've seen your name before. I have an insurance business. I'm an insurance broker. specializing, concentrating because there's a huge need for in Medicare and final expense.
Okay, I don't know if Mr. John or whoever can forward because I don't have access to chat to put in my contact information.
Well, I'll tell you right quick.
You don't
Um,
have access to the chat? Whoops. Hold on a
No,
second.
none of us do.
Uh-oh, I didn't realize that. I'm sorry.
yeah, it was disabled.
Whoops. Okay, it's
Okay.
fixed. I'm
I'm gonna
sorry.
put right quick. I'll put my information in. Or you can place yours. And we can both do it. Um,
Hi,
Sorry about
Christopher.
that.
All right, we'll let you guys share that. Did I hear someone else with a question?
Hey, Chris, can you put your information back up, your
Oh,
contact
sure.
information, or put it in the chat, please?
Absolutely. There you
Thank
go.
you. I was just about to
Thank you.
ask the same thing. Appreciate it.
No problem at all. And what was your name? I'm sorry.
Sierra Richards.
Oh, nice to meet
And
you.
the other, I'm not sure who's the other person.
the other
That's-
person?
She just requested for his information as well.
Oh, it's on the screen.
Oh, her name.
No, well, the presenter's name is on the screen and phone number.
Oh, yes.
Oh,
No,
I
we
see
were trying to
Monet
put,
has her information there now. I'm
Yeah.
sorry to interrupt you.
you're okay.
That's okay. All right. And I'll drop my info in the chat here too. That's so you can cut and paste it if that's easier.
And I'm
Yeah.
sorry, my name's Felicia. I was the initial person that asked for you to put your information up, Chris. So that was Felicia that asked that question.
Oh, gotcha. Okay. Well, nice to meet you as well. And thank you, Martha. I try to make it as engaging as possible, but it's kind of hard. It's kind of dry information. So I appreciate you guys following along.
Well, I'm going to tell you, we need that information now. So it was very interesting to me and very helpful. Thank you.
Oh, no problem. I appreciate you guys having me here to chat with you.
Boring and informative.
I guess that's better than boring and not informative. How about that?
Right, it's very good. It was not. It
agree.
honestly was not boring. It was very informative. So thank you so much.
Chris, if I were you, I would take that personal.
No worries, no worries. No, I appreciate it. Let's see. And Teresa, as a business plan required, are you referring to just general like a business loan application, or is there a specific scenario that you're asking about?
Just a general, I'll just give you a background. It's Teresa Harris. Hey, I financed everything in my business. Everything's paid off, have great credit.
Great.
Been in my home 30 years.
Okay.
But because I financed everything, and to get a loan,
Mm-hmm.
do I really need a business plan since I've been up in 5 years? We have no debt.
That's a great question. So it depends on the type of lending that you're going for. So for smaller, it's like if you're doing, I'll just use an example, like an SBA Express loan of like 150,000. Typically, they're not going to ask for a business plan for a existing business. Usually, what they'll do is get some sort of summary of what your business does, the background of it, your experience in the field, and that type of thing. But you don't need a full business plan. Generally, that's going to be for larger requests, more involved requests, or startup requests. But a lot of times, you can get by with some sort of summary, either written or sometimes they'll use. For some of the smaller lending requests, they'll use like an online portal where you can just kind of type in a questionnaire and it serves the same purpose. So that's a great question.
Okay, great. Thanks a lot.
Sure. All
Any
right.
other questions? Any other questions? All righty. Well, thank you so much, Chris. We appreciate you taking the time to give us this great information. Chris, if you could stop sharing just for or go ahead and stop sharing. I wanted to put something up just to let
Sure.
everyone know, a couple things we got going on here.
Okay. There you go.
We do have the DeKalb County Growth Accelerator had started or will be starting on Thursday. I don't have that flyer, but you can please reach out to me, connect with me, and I'll make sure you can get that information if you are a DeKalb County business. And also, we have next week we will be starting the Cobb County Small Business Development Program. You do not have to live in Cobb County to be a part of this program. So you can please join once it pops up on my screen. There you go. You can register. We're going to be doing some great things. We're going to be taking some little field trips along in this program. So it's going to be every other Thursday starting in March 5th, next week. So there's going to be some great training, and then we're going to do some little hands-on, and we're going to do some little field trips where we're going to be hanging out at some businesses as well. But all right, I want to thank you guys for your time. Again, Chris, thank you so much for coming to join us. And y'all have a great, great week, and we will see y'all again next week, next Wednesday at 9 a.m.
Thanks,
Great,
everyone.
thank you.
Thanks,
Thank
everyone.
you.
Enjoy the rest of your
All right,
week.
will
Bye.
do.
Bye-bye.
Bye now.
Bye-bye.
now.
Thanks, John.
I'm sorry?
Just said thank you.
Oh, thank you, sir.
It's Robert.
Yes, sir. I see. Thank you.
All right, man. You take care. It was a good
All right.
session.
All right. Thank you, sir. Y'all have a great one.
Bye bye.